Hi and welcome to Equities Bank. My name is Jonas Thulin. I'm head of asset management. Now we tried more briefly last week talk about what we think is the driving and explaining the rebound in equities and how we caught that and what is still speaking in terms of still favorable equity development. The methodology is the same. We derive everything by models. We do nothing in terms of what the consensus is thinking. I think this rebound was actually very proof in the point that was very beneficial this time around. Now, obviously, we're still outperforming our global indices quite a lot since the 1st, 2018. We've done some 40% more than the index, and we were trying to keep this up even this year. And you can see in our regional profile still unchanged since last week. We still have more exposure to Latin America than we do to Europe. We have a clear-cut reason for that. And one of the biggest reasons is that we still see deteriorating financial conditions and tightening in European region and also a slowing growth environment. And this is not to be seen in, for example, China, Japan, or US. Japan is really interesting right now. We think that weight of that in basket will actually increase in the next couple of weeks. So anyway, this is old news. We spoke about this to length last week in terms of the relative outlook and the relative performance between bonds and equities. They are neck and neck. So our party trick was to keep risk on the equity side, hedge it. That's where we were able to hedge it. More easily and cheaper than on the fixed income side. So we can use vol, we can use short positions and equity strategies and so forth. And then we let it all go in June, July. And then I would drive now the reason for that. We will skip all these macro factors that we're still looking at in terms of soft hard landing, in terms of geopolitical risk, in terms of the media exposure, in terms of US political risk. We note very quickly that the priced inflation in the US is now very, very low. The trajectory of this pricing in this market is completely the opposite compared to Europe or Sweden for that matter, which is obviously a more beneficial grounds, and that's why the equity flows are going to the US and not Europe. Quite straightforward and hugely beneficial for us using a lot of US equities in dollars. And I should also say in euros as well. Inflation, supply bottlenecks are clearly peaking, but that has been this case since 2021. The rest is just being more of a timing waiting and trying to manage the portfolios before spot and headline inflation and the equity market woke up. Obviously, the rate market woke up already back in March. But we all know the equity market takes some more time to adjust to the underlying macro. We can skip this, but it's obviously quite thrilling to note that the one-year inflation expectations amongst US consumers has gone from 8.5% to 3.2% within almost some 8-9 months. And that is, of course, we think, leading lower and lower headline inflation numbers going forward. Peak hawkishness, this is nothing new. We already knew from the onset of, even before they started hiking, we knew they're going to cut rates because obviously the CPI will roll over. Not necessarily making a transitory argument, but it's not going to stick around, this inflation. That's been the view in the rate market. The peak hawkishness was in March. We've been using this party trick on and off during the entire spring in terms of trying to establish when the market rebounded and always have a go and see if it sticks. In March, it didn't stick for that very long. We think it's going to stick longer this time around. Now, the Fed is dovish. We have to remember now, if you look at natural language processing, we can see that from the written communication that, yes, they are dovish. And quite a lot. If you look at the history, this has always put a downward pressure on yields. We think that will happen again. And I think it's interesting to always remember when you listen to Fed speeches that they are trying to manage the market expectations, given the fact that we all know that they're very dovish. That puts the speeches a bit more of a color, I think, than just going at them and thinking that they are hawkish and they're thinking this and that. We have to remember that they always have to manage the market. As we all know, and they are more dovish now than they were a couple of months ago. So I think that adds some color to how we look at Fed speeches. Now, I already discussed very briefly US financial conditions. I think one should be very careful on how to calculate this and how you look at the equities. So don't look at equity rebound, leading to easy financial conditions, and then make a dumb, silly argument that there's sort of an autocorrelation between financial conditions and the equity market. I think you have to use a bit more refined methods for that. If we do, we can still see that in end of June or July, financial conditions in the US rebounded, and it's still deteriorating in Europe. Now, when the financial condition rebounds, you have a first clue that the equity market will rebound as well. Because this means that a lot of the other markets, like dollar spreads, vols, are pricing in less risky and more benign equity environment. So this idea that this equity rebound is the most hated recovery in an equity market, I don't know, I'm a bit unsure on who hates this one, because as I will show you now, a lot of the market actually follow along. We can skip China, we can go into that, and we jump right into the equity sentiment. Equity sentiment rebounded in late June. So you know that you have financial conditions, which means that you have credit markets, vols, etc. You have the sentiment with you. All of a sudden, it becomes a bit interesting to sort of think, well, who's not on board on this equity rebound? And you can dig further and look at, for example, rate spreads, CDSs, FX vol, fixed income volume market, and you can see that, yes, it's pro-risk. We're above the threshold of 0, i.e. you should be long as long as you can. We've been holding on to long positions during this period. We can criticize us for, but I think this was the best we could do, given the fact that both global equities and global rates fell equally as much. We can hedge the equity side, and then we can efficiently drop the hedges and enjoy the rebound on the equity side. That was the whole party trick. And it's quite telling that all of a sudden you have all these markets doing the same thing. So that comes back to the question, who is really hating this recovery in the equity market? Implied versus realized vol made a beautiful little break. The ratio comes off. That is equal to an equity rebound. Fear and greed turned positive. This is a combine of 10 different models for fear and greed. If you look at the intermarket correlations, they came up during the sell-off and then have been plummeting quite rapidly. So not even how we trade in between the markets, how we can sort of extract stress from that and look at underlying correlations between different key asset classes is signaling increased stress. On the opposite, lower stress, i.e. more benign equity environment. And you can look at this again, JP Morgan's vol curve methodology showing the same thing, and you can look at high, lows, advanced, decline, bullish, bearish, and vol curve, and all of a sudden you see that this gap that opened up has been rapidly closing thanks to obviously then the equity market rebounding. If you look at those sectors, if you have highs, lows, advanced declines, and bullish and bearish, and vol curve, it becomes even more intriguing to figure out, well, why are we even talking about people missing out on this rally? I mean, what's happening? And if you look at the counterparty risk, dollar liquidity, vol curves, you have the same rebound in June, you have a huge gap opening up. It's perfect for us. 20th of June, we added our cash position to the equity market and have been enjoying quite a nice run since on a strategic asset allocation, as you can imagine. Also institutions, if you look at smart money index, is following up. And also if you look at margin depth, is also rebounding. So all of a sudden you have an entire shift in the market where I would say that everybody's on board, making this huge shift during the summertime. And the interesting question then becomes, why are we even arguing in terms of who's left out? But there is someone who's left out, and quite an important segment, and I will show you which one. Flows, they're back as well. And this is sort of an EKG kind of thinking I made when I made these models. I want to see, quite contrasting and strong signals, especially when we get flows that can sort of pinpoint the bottom. We saw the same thing in May, June. And now you see increased support again. So you even have flows. So you know that people are actually buying into this rally in the summertime, obviously. But who's not doing that then? And we know the institutions are increasing exposure to equities. Well, here's this first clue. This is consumers' confidence in rising equities, which is the lowest since 2012. All of a sudden you have this idea that starts to pop up, at least in my head, that you have the entire market and you have all the institutions, not all, but most institutions are turning around and enjoying the rally. And you have a consumer who can't see the rally and can't become positive. In fact, if we derive how the US consumer, what they experience how they express what they hear about the economy, they express it today as if ISM was at 35 in the US. I.e., this is the third worst economic environment that we had according to what consumers hear across media about the economy. I think this is really the culprit to the whole situation or problem. If you're a retail investor and you listen to media, you probably lost out on the equity rally. If you're any other segment or any other market, you're in the rally. Obviously, we think this could be quite interesting because if the consumers are getting on board, if you're already invested, there can be more momentum, more flows for us who's already bought the equity market. That's one side of it. The other side is quite irritating that we're going to listen to all this jitty-jatter about the economy being the third worst in 77, while we know that we think at least it's going to be very hard for the economy to fall into recession at all in 2022, and the market has completely mispriced this. And thanks to the lucky star that fixed income did equal the bad, the risk reward was quite easy. Hang on to equities, wait for the rebound, drop the hedges, and enjoy the rally because the market is fundamentally mispriced. And in that thinking or theorizing, we obviously lost the retail investor, which is a shame, of course. Now, very powerful, we also got the gamma position in the market. We all know that once we break the zero is the magic threshold. When we see buying interest and a low GEX, which we saw at the end of June, we knew that something quite interesting could happen. This is sort of almost like a catapult. If you move up in a positive gamma, you almost have a self-fulfilling spiral on the upside on the equity market, and vice versa. If you drop below, so you have negative gamma, which is quite an awful situation to be in, you're going to have the opposite. But this whole shift in the option pricing fundamentally, I think, shows us that this was quite a broad-based and enjoyable rebound. If you look at the put spread, the same thing. The equity market and the option side of the equity market, they're there. If you look at all options, if you look at speculative options, they're still there. They're still showing a rebound. This one, just look at the contracts. Here we look at a ratio, and then we can hot up the ratio and add in a lot more on the speculative option volumes. And then you can see that not only do we see a rebound, but they really bought into this rebound, speculative options. So again, I'm not so sure I buy into this hated rebound at all. I think it's on the contrary. Who missed out? And we know who missed out, which is a great shame. Now, we're far from any kind of exuberance in the market. If you look at PE versus VIX, this is Deutsche Bank's old euphoria indicator. It's very low, which is of course also stable and supportive for the economy. We hung on to growth, as many of you remember. We saw during the summer the fastest switch between growth and value for over 22 years. You could criticize us that we were too stubborn, but we always betted that our underlying indicator will be proven right. And given the gap, we speculated that the speed of this will be so fast that we cannot catch on to the train. We basically have to sit on the train and back up the positions by going short the S&P 500, by buying vol, by using whatever cash we can and play around with different segments within growth. That's exactly what we did in the year up to now. Now we dropped all the hedges and let the growth sort of run free in that sense and enjoy this quite powerful switch. Which I guess is quite reasonable. That from a retail perspective, it's quite difficult to see that you have the best momentum in growth versus value for over 22 years. Great for the portfolios, as you saw in the beginning, but we also think there's more of this to come. Now, equities in the first place, remember that we still argue that the equity and the rate market is priced in a recession that we will not see, so the risk reward is the same to enjoy that kind of mispricing. And we were able to hang on to equities due thanks to the rates also doing badly, and we could put on these hedges. Now the reporting season in Q2 came as we hoped and confirmed our positive outlook, and we can see the beginning of Q3 is actually looking quite strong as well. So this is quite important for us as well, that we were able to nail down the Q2 in terms of surprises. Because obviously if we had negative surprises, which a lot of people feared when we went into the quarter, and the net result will perhaps be a bit more less keen market for trying to capture the rebound. Now this is an old graph we showed a lot of months ago when we saw that the equity market is priced in an EPS trajectory that's not going to happen because we can't see that in the EPSs. Now the rebound is actually this little thin line here. It became quite quick, quite aggressive, and our thinking all along is that you will not catch that unless you sort of are prepared for it and can work with it. It's not unusual for the market to misprice EPSs and then catch a rocket on the upside. And that's exactly the same thing that we saw this time around as well. So this is another reason why we decided to have that strategy. And also good fun to see that the gap is closed, actually. In terms of credit facilities, so credit in the world, it's still increasing, which is great fun and great positive. Now we're going to skip the US recession part, but it's pretty much unchanged since last week. Actually come down a little bit with improving macro. But there's no recession alert for 2022. 23-24 is a different story, but then again, we'll deal with that when we get there. If we deal with it too quickly, well, you're going to lose money. So we have to be nimble in that sense. Our own high frequency model for the US is not showing any immediate recession risk either. And if you look at the data from National Bureau of Economic Research that define and time the US recessions, you can still see that we are in actually a recovery phase. We haven't even peaked. So it's a little bit iffy to call the US in recession, which is why I think the US Treasury came out in quite harsh words in terms of killing this. Is the US in recession or not? If you remember, there was a very livid debate a couple of weeks ago, and now it's completely gone. And that's not by chance or it didn't happen out of the blue. The discussion just disappeared. This is of course timely managed by obviously, for example, the US Treasury. The US macro is obviously then still improving on a relative basis. Now we will skip the coming data for this week and really jump into Sweden, because in Sweden we have a very interesting situation right now. We are trading, and this is very important to remember for the rest of what I'm going to be saying. We are trading OMX, the big large cap index, on US macro. If we were trading on Swedish macro, the things will look completely different. Now note, we traded on Swedish macro in the beginning of the year, and I will show you why that was. Because in the beginning of the year, ourselves and others came out with the predictions that the Swedish real estate market will not collapse, but downsize and fall quite rapidly. That has played out. In fact, if you look at building permits in Sweden now, we have a minus 26% on year-on-year growth, so this is updated on the downside. Prices will follow, activity will follow, etc., etc. Investors are pulling out cash as well. Now, on top of that, we have a Swedish consumer with a real wage income, which is just appallingly bad. We have high debt service ratios compared to the US. And this debt service ratio is pushed out by the fact that we are borrowing in order to consume short term today, which is obviously quite negative if rates move up, as they have and still will be doing in Sweden. This all boils down to this graph, which is really key. And if you remember, we traded on Swedish MAC in the beginning of the year. That's when we and everybody else were arguing that, well, hang on a minute, Sweden, which is this dark line, has the highest systematic risk in Europe. We used to have one of the lowest. If you look at that number and compare to where we are today, you can see that you almost get this OMG moment in terms of what's going to happen if Swedish equities start to trade on this number. We all know what happened when we traded on a quarter of the number. This is why the Swedish equity markets linked to the US macro is so important. If we break away from US macro and start trading Swedish macro, we're going to have a completely different development on Swedish equities, and we will act on that. The systematic stress indicator is built on the larger capital markets. It's built through various intermediaries and also from various institutions in terms of settling and clearing. What is concerning here, and I think I have my own idea of what's happening, is that we have over-regulated perhaps Swedish markets, so we have less capacity to build trading books and make pricing work, and that is suffocating everything from hedge funds with their indirect consequences further down the line to credit funds, corporate credit funds. Now, at the end of the day, if you take a holistic view from this, and as we have to do as an asset manager, the conclusion is quite straightforward. You want to be short Swedish krona as much as possible. We are, and it's been paying out, but we are a bit more nervous if what is going to happen if Swedish equity market starts to trade on Swedish equities on Swedish merits. Now, it becomes a little bit more interesting if you look at smaller caps, in which we think you really have to go and skip a lot of the market cap layers. We have, for example, a large cap portfolio trading on the US macro, and then we have a nano cap portfolio which trades more on the individual company's own merits. It's a little bit more of a win and lose situation, but if you get stuck in the middle, like small cap funds or medium cap funds, you're in this wishy water where you're probably going to get up being hurt. The fact that you don't get any liquidity, you're trading on Swedish macro, which is not great. So I think you had to use either sides of the scale on this question, and that's going to create a better portfolio for you. That's our take, right or wrong. That's how I trade this. Because it's a weird world when the global trade is still growing, as I show you here on this side, where some 4%, and we have this situation, a small open economy as we have in Sweden. So we're doing something quite uniquely bad in this country. And so far, it's not hurting us too much in the portfolios, but if we flip back and start trading Swedish equities on Swedish merits, we will trade differently. We can see this when we trade the equities now. We made a trade in a small cap company. It took us about 3 weeks to do the trade. This is equity we're talking about. This is not good liquidity. And this is an issue that we had to adopt to as a bank and as an asset manager. And we are. On the global scale, in our global mandates, which at the end of the day are some 92% of our mandates, we're still very happy in development in the US equity market, and we quite perhaps a bit more forward-leaning, a bit more challenging. We will not ask a question or make the statement, this is the most hated recovery. We would say, well, who missed out? And unfortunately, the answer to that is the retail investor, because otherwise the sentiment flows and everything wouldn't work in this way that it has. So I think it's very interesting to look at this rebound. We're going to stick to it for as long as we can and evaluate this on a daily basis, and we'll see what happens. We're going to be back in about a week and a half with an update on where we see the equity markets are going. We might do a little bit of a more in-depth dive into Japan and China. China is having a nice rebound today. Japan has very interesting development on the equity market, and luckily we are on board with Japan in all our portfolios. But if you look at Japanese macro compared to European, I can't really remember when Japanese macro looked this good compared to European macro, or even Chinese macro versus European macro. So it's a very interesting situation now to look at Asia. We are a bit more lukewarm to South America, but we keep on with that trade. But the big chunk of money, of course, in the US, we will still see a favorable development on earnings, too much negativity priced into the equity market, and a great rally that has been supported by flows, by options, by gamma exposure, by vol curves, counterparty risks, liquidity, financial conditions, etc., etc. I'll leave you there, and I thank you so much for your attention. I'll see you in a week and a half.